Hello and welcome to Ticker Tapes. Today, we're back in the world of ETFs. Last week, we highlighted how quickly investor sentiment changed as the idea of a Fed pivot was undermined. This week, we have to report that any notion of a pivot has been completely demolished by Jerome Powell's speech at Jackson Hole, the annual gathering of the world's central bankers. Chair Powell left the markets in no doubt about his resolve in raising rates to combat inflation, regardless of the pain it might inflict on consumers, investors, and the wider economy. The S&P 500 index, the global barometer for equity markets and sentiment, fell by 3.37% on that news and has now traded down for 3 sessions in a row, effectively undoing all the gains seen during late July and early August. Against this background, we might have thought that value investing would be back in fashion, but RPV, the S&P 500 Pure Value Invesco ETF, lost 2.25% last week, so that seems not to be the case. We need to look further afield to find some winners this week, and with energy supplies featuring so highly on the macroeconomic agenda right now, it's perhaps no surprise that we find URNM, the Sprott Uranium Miners ETF, is up by 21.56% over the last 5 days. We first flagged URNM in April on profit, taking it ahead of the Easter weekend after a 20% run-up its stock price. Given that we have now seen 2 20% swings in the space of a few months, this looks like a fund we should keep a closer eye on. Some of the biggest flows last week were into XLF, the Financial Select Sector Spider Fund, and once again, the ETF topped the New Money League tables with another $1.928 billion flowing into the fund despite the ongoing weakness in equity markets. The biggest loser on the week in terms of flows was QQQ, the ETF which tracks the NASDAQ 100 index, and further $680 million left XLK, the S&P 500 Information Technology Sector ETF. It's easy enough to make a case for those flows. After all, technology and growth stocks are thought unlikely to prosper in a rising interest rate environment. What's far harder to understand is why almost $440 million flowed out of SQQQ, which is a 3 times leveraged inverse play on the NASDAQ 100. Simply put, this fund does well when the NASDAQ 100 falls, as it returns 3 times the move in the underlying index. In fact, SQQQ rallied by 12.22% over the last week. Of course, leveraged ETFs are not necessarily suited to anything other than short-term directional trading, and it could be that these investors were happy to bank their profits and move on. ETFs that track the utilities sector are some of the worst performers in the market year to date. The sector is seen as defensive, and the stocks within it are often dividend payers. Someone has decided that these qualities are attractive and has invested $509 million into XLU, which tracks the S&P 500 utilities sector. Year to date, more than $4 billion of new money has now entered XLU, and perhaps we will start to see a return on that cash in the final quarter of the year.